In this video, we're going to look at two more sets of ratios, those referred to as market value ratios, and we're going to look at some relationship between a stock price and a line item or another ratio. And then we're going to look at some other miscellaneous ratios that have things to do with capacity, financing options, a few other things. So let's get started first with market value versus book value. Again, market value, I think, is a pretty self-explained kind of a number, right? It's the market price times the number of shares. Obviously, it can't be negative. We would hope, as we follow this discussion, that it would be much greater than the book value of the company. In the book value of the company represents the accounting value. And as we know, accounting values are historical in nature. So hopefully the company is growing in value at the marketplace compared to its assets that it owns. So the ratio we want to look at here is the market value or market to book ratio, sometimes called price to book ratio. And quite frankly, sometimes you even see this inverted as the book to price ratio. And we'll talk about that as we go further through the examples here. But again, the formula is you take the market price divided by the book value of the company. Now, the book value of the company, as I said, is the accounting value. Market price is the market value. Would you want your stock to have more value in the marketplace than what the accountants have on the balance sheet? And of course, that answer is yes. And what this tells us is the relative magnitude of the value of the company. If this number is greater than 1, it means that the stock is worth more than the company itself. So when you buy the stock, you're getting something more than what the accounting people say on the balance sheets. Now, this also gives us some inferences with respect to the type of stock it might be. High market to book value ratios are typically characteristics of growth stocks, where low numbers are more value stocks. But essentially what this is doing is it's talking about a measure of attractiveness to takeovers, right? If this number is very low, then it is a takeover target for maybe corporate raiders or somebody wants to take over the company. So again, one of the things that we might want to do is make sure that we can maintain this value so that over the long haul, we don't have to worry about those outside influences by those corporate raiders. And we'll talk about this a little bit more in later videos when we talk about buying assets, when we talk about the valuation of equity, etc. So here's a quick little example, right? We have 5 million shares. The market price is $108. The book value of equity is $50 million. So what is the market capitalization of the stock? Well, market capitalization is the 5 million times 108. So what that tells us then is that the so 5 million times the $108 means the market value is 540 million. If you divide the 540 million divided by the book value of equity as 50 million, then we ultimately have a market to book value ratio of 10.8. So that means that the value of the company at the stock market is over 10 times more than what the value is of the company. If we look at the company that we've been following in this ratio analysis, we find that it has a peak in 2015, and since there it has been declining. And the market price relative to the book value has been going down. So again, if you think about it, which is going down? Is if the market price is staying the same, but assets are increasing, then you would expect it to go down. If the market price is going down and the book value is staying the same, again, you would think that it's going down. So we really don't know which it is. We just know that relatively speaking, the value of this company to owners has decreased since 2015. Is that because they don't like the company's current strategy? So there's not a great demand for the stock? Or is it that the company has expanded so much that the assets have increased and the market price has stayed relatively the same, or market valuation hasn't changed much? So again, where this fits into the plan and how it helps us gives us some ideas about the general value of the stock. And one of the things we mentioned, if this number is relatively low, it's an indicator that it might be a value stock, or a stock that for some reason the stock price is less than what you might think it should be. Enterprise value is an interesting calculation. Enterprise value tells us what does it cost to buy the company, pay off all the debt. So essentially it's what does it cost to buy the firm and then have zero leverage, no borrowed money. So what would you need? You'd have to buy all of the stock. You'd have to have enough money to pay off all of the debt. And if the company did have any cash, you would use that cash to offset that. So enterprise value says, look, what would it cost to basically acquire this whole company and then have zero debt? We can use that in several ratios. The first ratio, again, coming back, we're going to talk about the PE ratio, basically measures investor optimism. The higher this number, the more people appear to be willing to pay for every dollar of earnings. Enterprise value to EBIT, and sometimes they talk about how cheap is this stock. This might be what some people call an improved version of the PE ratio, because it looks not at market capitalization but enterprise value. What are you buying when you buy the company compared to EBIT, which is the operating profit? So again, a very high number means this company might be overpriced. If it's too low, it might be underpriced. So again, we wanted to look at this number, obviously relative to some other variables. The enterprise value to sales, again, just tells us, given the sales of the company, how much are we willing to spend to buy those sales? Again, bigger numbers represent overvalued companies. So we had looked at this ratio a little bit earlier, the PE ratio, and we had mentioned why there could be changes in the PE ratio. Just looking at the graph, it tells us that for some reason, investors are not willing to spend as much money for every dollar of earnings per share as they used to. We may want to explore that. So let's look at the enterprise value ratios. Again, if you look at enterprise value to sales, see that relatively hasn't changed dramatically over the last couple of years, although there's a little bit of a decline here the last year. But the enterprise value to EBIT, how expensive is this stock, basically has had some variation. And it looks a little similar to the PE ratio, except there has been a pretty big rebound in this last year. So again, what does this tell us? Relatively, how expensive is the stock? We would like to see this relative to some other benchmark, right? So what is the enterprise value to EBIT? What is that for our competitors? What is it for an industry? So we would know where we fit in the company. Unfortunately, these things aren't necessarily published for industries And for companies, we can calculate that, but obviously it would take a little bit of time to calculate those things. But we can get the data if we really want it. So now let's move on to what I refer to as just some miscellaneous ratios. We want to talk about growth and financing. If a company is growing, it has to invest funds for the growth. How are they going to finance that growth? Profit only would be best, but what about when they exhaust this internal funding, right? Retained earnings, where should they go? When will they have to go from debt to equity into that external financing mode, if you will? So first, let's look at capital intensity, right? Should we even buy assets, right? So this number basically says companies with high ratios need more assets for their current sales level. So it reflects potentially either too much assets or obviously not enough sales, and we would want to review this. So again, a very high number might represent that we're overusing our asset base. What's the problem with overuse of assets? They wear out quicker. Maintenance increases, so the costs increase. Because they're wearing out, they may produce more scrap. They may produce more problems or challenges with the materials that we're creating. So we want to have a decent mix of using our assets and replacing them over time. So if you look at the capital intensity ratio, right, we can see here that in general the company has a much higher number than the industry. So again, what does that mean? A higher number means we're using more assets. We're using our assets more. In this case, it's a pretty high number compared to the industry. So we might want to make sure that we're not overusing our assets. When you look at fixed assets in general, we see we're pretty close. There's not much of a difference. So if you're looking at total assets compared to fixed assets, it appears that we're overusing those assets that are not fixed. So it's our current assets that are being challenged here. Possibly it's also maybe our intangible assets are here because they're obviously part of total assets. So again, just gives us a picture of how we're using our assets and maybe whether or not we need to replace them. And if we have to replace them, how do we refinance that, or how do we finance that? Sustainable growth refers to then where do we get the money to finance these things? So they represent the level of growth that we can sustain before alternative financing is required. So the internal growth rate is the maximum growth rate of sales that can be financed with profitability, right? So that means there's no borrowing and no stock is going to be issued to cover this growth rate. That's this internal growth rate here. Sustainable growth rate, that's the maximum sales rate of borrowing that must take place until borrowing has to be utilized. Right? So that's this ROE divided by ROE minus the dividend payout ratio. So again, this just gives us two lines. We need to know the company's sales rate. If the company's sales rate is less than internal growth, then we know that we will be able to finance operations with just the profits of the company. We won't have to go outside the company. If the sales growth rate is greater than the sustainable growth rate, then borrowing's not going to be able to cover it all. We're going to have to use all of our retained earnings, all of our borrowing capabilities, and then we may have to go outside the company to issue stock. So if we look at the company, we see that in general, the sales growth rates are fairly high for these last couple of years. So that means the ratios needed, right? This is the maximum growth in sales to use profits. Tells us we're going to far exceed that. sustainable growth. These are the growth rates that we could maintain and only use internal growth and borrowing. So this tells us that if we're going to grow at these growth rates, we're going to have to do it with both internal financing, retained earnings, borrowing capabilities, and we're ultimately going to have to issue stock to maintain that. This could be some of the reasons why some of our ratios are falling. Shareholders may not be happy with diluting the ownership of the company and dividing the profitability. So again, that's what these growth ratios help us to understand and develop. What will our financing need be in the future? The last thing we want to look at are what are referred to as cash flow ratios. We've had several ratios: return on equity, return on assets, and operating profit margin. All of those ratios we've talked about before, but they were in the context of line items. In this case, we're going to convert the line item, the other ratio, if you will, we're going to convert it to a cash flow number. So instead of EBIT divided by net worth, we're going to have EBITDA. EBITDA is earnings before interest and taxes, plus depreciation. So I don't need this, right? So it's earnings before interest, taxes, EBIT, plus depreciation. So now it's an operating cash flow number. How much operating cash is generated given investors money for net worth? How much operating cash flow is created using the asset base? And finally, how much operating cash flow is created given the sales of the company? So these numbers, some may argue, are far better numbers to analyze owner investment returns, returns on assets, and operating profits, because it incorporates cash flows. And what we find is that the numbers actually follow pretty much similar guidelines or trends, that over time these cash flow numbers have been increasing. So the cash flow to owner equity, that's net worth, that's been going up. It's gone from 10% to over 26%, right? So it's over almost doubled, right? EBIT over doubled in the last 5 years. Likewise, the same thing with EBITDA to sales, right? So that profitability number is going up. The return on asset relationship, that has increased. So we're seeing the cash flows are increasing relative to these line items. And as an investor, that is very good news. As a creditor, this is very good news. It represents, even though some of the information we talked about before is a little marginal, if you will, about how well this company is performing, I think it also gives us a picture that at least cash flows are increasing for this company, which is nothing but good news. Look forward to talking to you in the next video. Sorry.